Bitcoin just posted its worst month since June 2022, down 19% in February. Now the Fear and Greed Index is currently at 11 out of 100, and that is extreme fear territory. But yesterday, we did a 3% pump, so is the worst over, or is this just a pause in the middle of something bigger? Today we're going to do three things. We're going to break down exactly what happened to this market in February and why. Then we're going to cover the Jan Street lawsuit and what it actually means versus what Twitter is claiming it means. And then we're going to zoom out to one of the developments this week that most people are sleeping on. Now let's start with the market. Bitcoin peaked at around 126,000 in late October 2025. As of this week, it has fallen roughly 50% from that high, sitting in the low 60,000. Now February alone accounts for nearly 20% of that drop, the worst single month since June 2022. Now you might be thinking what caused that. Now obviously there's not one reason, but many of them, and they all hit at the same time. The ETF feedback loop turned negative. When Bitcoin ETF first launched, they were a buying machine. Money flowed in, fund manager bought Bitcoin on spot market, but now the loop is running in reverse. From November 2025 through January 2026, spot Bitcoin ETF bled roughly 6.18 billion in net outflow. We're talking about the longest sustained outflow streak since these products launched. Now, when investors pull money out of an ETF, the fund manager has to sell the underlying Bitcoin to give them cash back. That selling pushes the price lower, and lower price trigger more people to pull out, and the cycle repeats. Now, BlackRock IBITs alone saw 2.13 billion in redemptions during that stretch. Going into February, Trader had been building up leveraged long positions, so we're talking about Trader betting that Bitcoin would keep climbing. Now, when the price broke down instead, those positions got forced closed automatically. So total open interest in Bitcoin derivative, basically total size of all open bets, dropped by 22% in a single month, from 815 billion down to 338 billion. Once Bitcoin fell below 84,000, which was roughly the average buy-in price for ETF investors, stop-loss selling kicked in and added even more pressure. And don't forget, the Federal Reserve kept interest rate unchanged at 3.5 to 3.75% in January. While inflation held at 3.4%, Fed official this week signaled that rates will probably stay high for some more time. Now the next rate decision is scheduled for March 17 to 18, 2026, so we're looking at about 3 weeks from today, and the market are currently pricing in a very low chance of a cut at that meeting. So when rate stays high, money tends to flow towards safer assets such as bond, cash, gold. Now, JP Morgan has gone on record saying that Fed could stay on hold all year, with unemployment rate sitting at about 4.4%. The environment is going to put pressure on anything considered a risk assets, and it seems like Bitcoin currently fits right into that picture. Now, back in January, gold climbed above 4,900 and briefly touched 5,600, while Bitcoin fell 40% over the same period. And that contrast has made a lot of institutional investors question whether Bitcoin is really a store of value or just another growth bet. Now let's look into something that is less talked about. Some hedge funds were running what is called a basis trade inside the Bitcoin ETF complex. Now, here's how it works. You buy the ETF while same time shorting Bitcoin future. But when volatility picks up and liquidity thin in, such as early 2026, those traders had to be closed in a hurry. Now that meant selling the ETF and buying back the futures at the same time. In terms of price action, that means you're going to add extra downward pressure onto the price exactly at the wrong moment. Analysts call it the Great Flush because the total forced deleveraging has been described as one of the fastest de-risking events in crypto history. We're looking at a negative 6.05 standard deviation move in terms of speed. So where is Bitcoin now technically? I personally think the key support level to watch is going to be 58.5 to 60,000. So we're talking about the floor that was held during the previous bear phase. Below that, a lot of analysts are flagging the 55K range as the next area of support. So that is the market picture. Now let's get into the two stories running underneath it. On Monday, the person legally in charge of winding down Terraform Labs, FYI, the company behind the 2022 Terra Luna collapse, filed a lawsuit in Manhattan federal court against Jan Street. Now Jan Street is one of the most profitable trading firms in the world. Last quarter alone, they reportedly made over 24 billion in revenue. And they're not a bank or hedge fund. They are a market maker, meaning that they sit in the middle of trades, buy on one side and sell on the other side, and take a cut. Now they're also an authorized participant in BlackRock Bitcoin's ETF IBIT, meaning that they're one of the very few firms that can create or cash out large blocks of ETF shares directly with BlackRock. Now that is a very privileged position not available to normal investors like you and me. So here's what the lawsuit specifically claims. On the 7th of May 2022, Terraform quietly withdrew 150 million in UST from a liquidity pool on Curve. For those who don't know what Curve is, it is a major DeFi trading platform. Now they did not announce this publicly but kept it internal. Within 10 minutes before any public announcement was made, a wallet connected to Jan Street withdrew 85 million from that same pool. Now that withdrawal helped push UST off its $1 peg, and once the peg broke, the system collapsed. Luna went from $80 to nearly zero. And for those who remember this historical moment, 40 billion was wiped out in a week. Now how did Jan Street allegedly know? The lawsuit points to a former Terraform intern named Bryce who claims that he set up a private group chat called Bryce Secret with former Terraform colleagues to receive confidential information. Now, obviously, Jan Street has denied everything. Their response was blunt. They called the lawsuit desperate and baseless, basically saying that the Terra Luna losses were caused by Terraform's own fraud, not by Jan Street trade. Now, this lawsuit also gave fuel to a theory that had been circulating on crypto Twitter since November 2025. A lot of traders noticed a recurring pattern, which is Bitcoin kept getting hit the exact moment the US stock market opens, and the pressure window tends to run from 10 a.m. to around noon, with the actual drop happening in roughly 10 to 35 minutes depending on the day. Now, crypto Twitter started pointing fingers at Jan Street, noting that their IBIT holding of 790 million gives them the scale to move the market. Now, the theory goes like this: sell Bitcoin at market open, flush out leverage longs, and buy back cheaper. Research on where the actual selling is coming from points to Asian exchanges such as Binance, Bybit, and OKX, not Coinbase, which is the exchange most connected to US institution flow. The cause has not been confirmed by any regulator or formal investigation. Whether it is coordinated or simply the result of multiple large players doing routine hedging at market open, that question has not been answered. But what we do know is that the lawsuit is real, the timeline and the complaint is specific, and this discovery could eventually force Jan Street to disclose internal communications from May 2022. Now, if that happens, you best believe that the market is going to react. Okay, so quick detour before we moved on, and this one is just for fun. Yeah, I've heard the theory now, but instead of just taking anyone's word for it, including mine, I wanted to give you a way to actually look at it yourself on the chart. So I threw together a simple script from TradingView. Now, TradingView is a free charting platform. If you have never used it, you can sign up for free at tradingview.com. Think of it like Google Maps, but for price chart. Now, I want to be upfront. I'm pretty new to coding these kind of script, so it is more of a fun experiment than a polished tool. There might be a mistake in it, but here's what it does. You open TradingView, you pull up Bitcoin's chart, and you set it to a 5-minute candle view. And then you paste this script in. When it runs, it does 3 simple things. First, it draws a faint red box over 10 a.m. to 10:35 a.m. New York time window every day. That is the exact window the theory is talking about, and you will literally see it highlighted on your chart. Now, second, it does some basic math inside that window. It measures the biggest percentage drop from the 10 a.m. starting price, and it adds up the total amount of Bitcoin sold on red candle during that period. Now, third, at 10:35 a.m., it prints a little label on the chart. If the drop was 1% or worse during that window, it lights up bright red and flagged it as potential slam. Now, if the price barely moved, it stays gray. Now, one important heads up, because the script waits for the full 35 minutes window to close before it prints the label, you cannot use this as a live signal while the dump is happening. This is just a way to look back at what happened and see if the pattern matches the headlines. Now, I have already put the full script in my Telegram group. Drop in, copy the script, paste it into your TradingView, and add to your chart. If you know how to code and you spot something that I got wrong, fix it and share it in the group. I would genuinely love to see what you guys come up with. Now, last but not least, let's get into the most important story today. ZachXBT, the legendary on-chain investigator, is going to drop a major investigation on the 26th of February on one of crypto's most profitable business. And Zach told us that he found out multiple employees abusing internal data to inside trade over a prolonged period of time. And once the tweet was made, the market immediately priced in the uncertainty. Polymarket prediction market opened asking which company would be named, and the volume immediately crossed 5.6 million, where people putting real money down trying to guess. The current leading candidate on Polymarket is Meteora, a Solana-based liquidity platform sitting at 43% odds. The mechanic being alleged is straightforward. Employee with access to internal information such as which tokens are about to be listed or which protocol are about to receive a major upgrade, buy those tokens before the announcement goes public, then sell into crowd once the news drop. Now, step back from all the information today for a moment. While the price action has been brutal and 2 major accountability stories are playing out, something else has been building quietly. Standard Chartered, one of the world's largest banks, published a report this week projecting that stablecoins could generate $800 billion to $1 trillion in fresh demand for US Treasury bills by 2028. Now, here's how that works. Every dollar minted in a stablecoins like USDT or USDC needs to be backed by real assets. Now, the safest, most liquid assets available is a short-term US Treasury bill. So as stablecoin grow, the companies behind them, such as Tether and Circle, have to buy more T-bills to back them. Standard Chartered projects that the stablecoins market grows from $300 billion today to $2 trillion by 2028. That kind of growth means stablecoin issuers could become some of the largest buyer of U.S. government debt in the world. Now, Treasury Secretary Scott Bessent has already acknowledged this publicly in congressional testimony, calling the Genius Act an important feature of financing the U.S. government. On top of that, Yahoo Finance partnered with Coinbase this week to give its users direct access to crypto trading. Now, the SEC removed additional stablecoins guardrails, and stablecoins revenue projections from multiple analysts suggest the sector could grow 7 times if payment adoption accelerates. So while the market feels like it caught a brief bit today, the data tell us the underlying deleveraging is not fully resolved, the macro headwinds are still in place, and 2 significant information events are just getting started. Alright, that's what I have for you guys today. If you feel like I missed anything, drop a comment below. If you found this useful, drop a like and subscribe. I'll see you in the next one.